Hey everyone, it's Ben Hardy here, and in today's video we're going to be talking about auto loans. I know, not exactly the most exciting topic, but there have been a bunch of changes over the last few months, and if you're considering buying a car anytime soon, you need to know exactly what's happening so that you don't put yourself into a bad situation. Before we get into the video though, as always, if you're going to save time and money the next time you purchase a car, link to my car buying guide in the description down below, and if you want to see more content like this, then subscribe because I post videos every single day. Let's get into it. Now, I just posted a video talking about the rapid decline in car values over the last little bit, and in that video I talked about auto loans, but not a lot because, well, auto loans need their own dedicated video. So what we already know at this point, auto loan rates have increased by a very large margin over the course of the 2022 sales year, and it's pretty shocking when you look into it. So at the beginning of the year, if you had top tier credit, so I'm talking 760 and above, and you found the right lender, you could get an interest rate of under 3% for an 84-month loan. And I know I'm going to get a bunch of people in the comment section below talking about how an 84-month loan is the dumbest thing you could ever do, and how if you can't afford the payment for a 48 or a 60-month loan, then you shouldn't buy a car. And hey, fair enough, but let's be realistic here. The average person in the United States makes about $50,000 per year, and the price of the average brand new car is about $50,000. So do you really think that the average person with the average income can afford an average car at a very short loan term? The answer is no. So yes, people have to go to longer loan terms because that's just all they can afford. It's just the reality that we're in right now. It sucks. It's not ideal, but it is what it is. So anyways, perfect credit. You could get a rate of under 3% for 84 months. Now, it's rare if you'll see an interest rate of under like 6% for 84 months with perfect credit. Now, there are some people that are going to say, well, I got 4 point something percent or I got 5 point something percent. These rates just got released for October. And so if you just took out an auto loan sometime in September, yeah, there is a pretty good chance that you're able to get somewhere in the 4 to 5% range. But now in October, that's going to be a lot more difficult because a lot of lenders just increased their rates, which makes cars a lot less affordable. In the video that I just posted talking about the decrease in car values, I talked about how much this actually affects a car payment, because unlike a mortgage, a car payment is over a relatively short term, right? Most mortgages are over a 20, 30, sometimes even a 40-year term, whereas a car loan right now is over a 5, 6, 7, and some people even doing 8-year terms, which is absolutely crazy, but people are doing it. And so because it's a shorter term, when you have these increase in interest rates, it really skyrockets the payment. And yes, it does increase the payment by a large margin on houses, but with cars, it's pretty substantial when you look at it from a percentage perspective. And so if you take like a $50,000 vehicle and you give someone a 3% interest rate on that vehicle for 84 months, their payment's going to be what, somewhere in like the $700 range. Sorry if my math's a little bit off, but somewhere in like in the low 700s. If you take that same $50,000 car and give someone an 84-month loan with like a 7% interest rate, then they're paying closer to like another $100 a month more roughly. So they're paying like $800. Quick mental math there, messed up a little bit, but you guys get the point, right? The payment increases by a pretty large margin when you look at it from a percentage perspective, because that's an increase of like, what, 15% roughly? I mean, it's pretty substantial. Again, the math is not exactly the best in today's video. But moving from the fact that, increased interest rates make cars a lot less affordable, and you just need to know that in today's market, we need to talk about loan to value. Now, what loan to value is basically a lender puts a value on the car that you're getting a loan on, and then they have the loan amount that you're trying to take out. And so the way that this is calculated is pretty simple. So like, let's say that I want to buy a $100,000 car. I'm going to make the math simple this time so that I don't make stupid mistakes. Let's say I want to buy a $100,000 car and I want to take out a $100,000 loan on it. That means my loan to value is 100% because I'm taking out a loan that is worth 100% of the car's value. But let's say that you want to take out a loan for, $80,000, then your loan to value is 80%. And let's say that you want to take out a loan for $120,000, then your loan to value is 120%. Now, over the course of the last couple of years, lenders have been, well, not last couple of years, more like the last decade or so, lenders have been pretty slack when it comes to loan to value. Some lenders were willing to go up to like 140% 150% in some cases. Like, they were giving out crazy loans on cars. And on top of that, they were pretty much approving everyone, because with auto loans, unlike a mortgage, you don't really have to give lenders all that much, especially if you have good credit. Like, I can literally go into a dealership, and if they pull my credit score above 760, I can tell the dealership I make whatever I want to make. Like, I could say I make $20 million a year if I wanted to, and the lender will take that because they go, oh, this person's got really good credit, and so yeah, we'll just go with it. And believe it or not, this was happening all the time. And so people were basically going into dealerships that had good credit, and they were, fudging how much income they made so they could get approved for a car that they really couldn't afford. And now we're starting to see a lot of repossessions because of this. But why did I bring up loan to value with this whole situation? Well, the reason I brought up loan to value is because not only were lenders basically giving everyone an auto loan if they had good credit or, relatively decent credit, on top of that, they were giving out these huge loans on cars, loans that were worth way more than the value of the car. Now, over the last couple of years, car values have increased by a massive amount, so it's actually made it pretty good for lenders, because if they do have repos, then they're able to very easily sell those cars that have loans on, even if the loan to value is over 100%, because again, car values have increased by such a large margin that it actually works out typically in the lender's favor, where again, they're able to, break even or sometimes make a little bit of money. But that's obviously stopped at this point. And so what lenders are doing is they're pulling back a massive amount. And so most lenders won't go over 120% at this point. And on top of that, really hot cars that are selling for huge premiums over MSRP, like, Ford Raptors and all that kind of stuff, lenders are now really diving into those vehicles specifically and saying that we don't even want to do 120% sometimes. It depends lender to lender, but they're getting really strict because they do not want to be giving out loans on what I'm going to call quote unquote hype cars, right? Cars that get sold for huge premiums over MSRP because there's a lot of hype behind them, because what happens is you have a lot of initial hype, and then the hype dies, and then the values drop by a massive amount, and then you have these people with these overinflated car loans that can't quite pay them off, and they can't sell the car because now it's not worth nearly as much as what they paid for it, and it's this whole underwater situation that hurts the person that bought the car, it hurts the lender. It's just not a good situation. So lenders are trying to protect themselves from that. And so they're looking at invoices again. They weren't looking at invoices in the past, and they're giving out loans based on invoices on cars, not based off of MSRP at this point. And so a lot of lenders are saying 120% of invoice, not MSRP. And so what this means for you as a consumer, and that was a really long-winded explanation, is that lenders are a lot stricter, and you need to avoid purchasing hype cars at this point if you're going to take out a loan on them. Now, I understand there can be an argument where you go and purchase this car to then go and sell it for a profit, which it's becoming more and more difficult to do that because the market's fluctuating so much. And so I probably wouldn't do that unless you are really you have a really good pulse on the values on that particular car. But in general, I just would avoid it at all costs. And I would treat the purchase of a car right now like what you would treat it as before this whole COVID market. So negotiate with the dealership. Make sure you're getting the best possible interest rate you can get. So, talk to multiple lenders. You can use Google too, right? Look at what good rates are in the current market. So make sure you're getting the best possible rate that you qualify for with your credit. And don't buy these hype cars that are being sold for crazy premiums over MSRP right now, because the market's just fluctuating so much that the value is not necessarily there. And what that also means is you probably don't want to be rolling over a bunch of negative equity into a car right now, because again, values they're not very stable right now. And so there's a pretty high chance that if you take out a loan that's over 100% in terms of the loan value on a car right now, you're going to be way more underwater in the next few months than what you would be today. And so it's not necessarily worth it. Now that's pretty much going to sum things up for today's video. I do want to make one last point though before I fully cap things off, and that is the fact that I think that now is a time to be patient, because the market just isn't as crazy as what it was in the past. And so understand that cars are starting to become replaceable again. I think that there was this huge mentality shift last year because cars were selling so fast that people are like, I gotta jump on the deal because if I don't, the car's gonna be gone. Yes, that is happening with certain cars at this point still, but it's slowing down by a massive amount. Manufacturers are starting to ramp up production. And again, people are starting to pull back from buying. And so the whole supply demand thing is starting to shift more towards being a buyer's market rather than a seller's market within the car market. It's still more on the seller's side of things, like I've said several times. But what I would do if I were purchasing a car today is I would just be patient. I'd wait for the right deal. I would definitely negotiate with the dealership that I'm purchasing with, because again, buyers do have negotiating power. And I would not purchase a vehicle in today's market if I did not have a really solid credit score, because interest rates are already really high. And so even if you're getting a top tier rate, it's still kind of painful. And so if you're not getting a top tier rate, it's like really painful. I mean, we're talking, 9, 10, 12% interest rates. And for people that have really crappy credit, I mean, the sky is the limit at this point. I've seen people getting, 20+% interest rates, and it's definitely painful. But the point that I'm trying to make is, if I were to buy a car in today's market, I want to have really solid credit. I want to have a big down payment or a car with a lot of equity, so that I'm going into the purchase where I have a loan to value that is far under 100%. And again, even though not an amazing interest rate, a good interest rate for today's market, so that I'm not going to end up being super underwater in the car, especially if the economy gets even worse. With that being said, I will see all of you in the next video.